You are listening to Let the Money Talk podcast, a podcast where our PhillipCapital's experts deconstruct world-class tactics, tools, and routines for managing your finances. I'm Rashawn, your host. Money never sleeps. Stay tuned for our experts' top tips.
Good afternoon. I'm Rashawn Gidwani, and welcome to Let the Money Talk. It's good to have you all with us. I'm PhillipCapital's media host and presenter, and today we have a very special guest who goes by the name of Claire Xu. Claire, take it away.
Hi everyone, I'm Claire Xu, a wealth manager at PhillipCapital with dual license in securities trading and financial advisory. Today, I'm going to talk about an important aspect of wealth management, asset allocation. Just a disclaimer before I begin. My sharing is purely my personal opinion and should not be construed as specific financial or investment advice.
Awesome. So Claire, tell us, what is asset allocation?
Asset allocation is actually a strategy that aims and reward by apportioning assets into different classes according to your financial goals, risk tolerance, and investment horizon.
We often hear people saying 60-40, 90-10. What does this jargon mean?
Well, 60-40 refers to a portfolio, 60% in equities and 40% in fixed income instruments, whereas 90-10 refers to one that has 90% in equities and 10% fixed income.
Right. Thank you. Why are there different portfolios with different percentage allocations?
Well, this is because the financial goals, risk tolerance, and investment horizon actually vary for individuals. Our thinking will also continue to change and evolve as we age. So maybe a 90-10 portfolio could be suitable for someone with a fairly long investment horizon, which means he doesn't need to use the money until perhaps 10 years later. And additionally, he has a fairly high risk tolerance, meaning he's willing to stomach potentially huge fluctuations in the value of his investments in order to pursue potentially higher returns. A 60-40 portfolio may be more suitable for someone who wants a good balance between risks and returns. And as one approaches retirement, he may scale down the proportion of equities and hold more fixed income instead, so as to preserve the wealth he has accumulated throughout the years and receive regular streams of passive retirement income.
So let's say I have a super high risk appetite. I just want the highest possible return. Can I simply invest 100% in equities? Why do asset allocation?
Well, I come across many customers who share the same thinking as you. After all, high risk, high reward is a general saying that we hear so often.
Right.
But is it actually true? In fact, with the help of an effective asset allocation strategy, you may be able to achieve comparable returns without having to take on high risk. Because different asset classes generally don't move in the same direction at the same time. In other words, they are not positively correlated. So if you combine the different asset classes that have low or negative correlations to each other into a single portfolio, you can significantly reduce the risk, which are represented by the volatility or variability of the portfolio's returns, and still achieve a solid overall return. According to a PIMCO study over a 20-year period from 1998 to 2017, comparing a portfolio of 100% equities, right, versus a portfolio of 60% US equities and 40% US bonds, right? Comparing these two portfolios, actually, they actually find out that the average annualized return only dropped a small 0.6%, but the risk actually dropped by a whopping 6%. So actually, you can find more information and stats relating to this topic on the internet, but you can see that asset allocation is actually a very effective way to reduce risk while still earn very good returns.
Amazing. Now, how can I devise an effective asset allocation strategy?
Okay, there's no one-size-fits-all strategy that works for everybody. An asset allocation strategy that is optimal for a specific individual has to take into consideration his goals, investment horizon, risk profile, as well as his financial circumstances. So usually the steps that we do, right, is like an emergency fund that covers your near-term expenses, typically 6 to 12 months of expenses, either in cash or money market funds, right, super liquid. And then you should reserve funds for other short-term goals, which are events that may occur within the next 2 to 3 years, such as marriage, down payment for house, purchase of car, etc. These should be kept in risk-free or in very low-risk liquid instruments, such as treasury bills, fixed deposit, or money market funds. And then you can invest the surplus, also known as investable assets or investable capital, based on your risk profile. So, for example, if your risk profile is high, you can have a higher weightage in equities and other high-risk products such as CFDs, options and futures, forex, crypto, etc. If your risk profile is low, then the bulk of your surplus should be channeled to lower risk products such as fixed income instruments and cash value insurance plans, which typically offer a certain level of guaranteed returns. So after this broad allocation among asset classes is done, you will need to further perform sub-asset allocation or diversification within each asset class. Thereafter, you should monitor your portfolio and rebalance it periodically, bringing it back to the original target allocation. Of course, your target allocation should be reviewed and adjusted when your circumstances change so as to ensure that you don't.
Absolutely. Nobody wants that. But wow, that sure sounds like a lot of work. I think it'll be hard for me to implement it myself. What do you say, Claire?
Yes, absolutely. It requires a lot of research, analysis, forecast, and judgment, right? Which only come with experience. So perhaps we should start by having a conversation with a licensed financial specialist today.
I totally agree. Wow. Thank you so much for your insight, Claire. You can visit. Thank you, Claire. You can visit the nearest Phillip Investor Center for further assistance or connect with Claire by visiting bit.ly/Claire Xu. That's CLAREXU if you have further inquiries. Stay tuned for our next offering, which will be released soon. Also, tune in at 10 a.m. every day, Monday to Friday on YouTube and Facebook for Singapore's most up-to-date financial news, the Daily Morning Note, presented by me. See ya.
See ya.
Thank you very much for listening. If you enjoyed this podcast, please forward it to others, share it on social media, and leave a review. Follow this channel for other podcasts.